Welcome back everyone, I hope you're having a great day, and in this video we're going to take a look at 3 high dividend paying companies that provide their investors with some massive passive income. All 3 companies we're going to take a look at have a current dividend yield above 5%, pay a growing dividend each and every year, and have a dividend safety score that's considered safe or very safe according to Simply Safe Dividends. So if you're the type of investor looking for some current cash flow into your portfolio, but is willing to give up some long-term capital appreciation in the process, these are 3 companies worth taking a look at right now. And for each of the 3 companies, we're going to take a look at their current operations, go over some financial metrics, and of course, evaluate their current dividend. But before we jump into that first company, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z Investor, and on this channel we talk about the stock market, go over any major stock market news, and I track the progress of my personal stock portfolio that is now at a value of $156,000. So if you're into investing content, please subscribe down below. And now we're going to jump straight in to the first high dividend paying company, and that is ticker ENB for Enbridge. They currently trade for $40 per share, and on the 12-month chart, the company is down only 4%. So when the overall market is down over 10% on the year, Enbridge has held up pretty well in this market downturn. They are a large company with a market cap at just over $80 billion and an absolutely massive current dividend yield at 6.85%. So this company is an absolutely massive dividend payer, and they trade with a very conservative 4PE ratio at 18.6. So if you're unfamiliar with Enbridge, this is an oil and gas pipeline company. They operate with 4 main business segments, which include liquid pipelines, gas transmission, gas distribution, and also renewable energy. As we all know, our economy is gradually moving towards renewable energy as a primary source of energy generation. I do think we are decades away before it becomes the #1 source, but Enbridge has done a great job of growing that segment of their business each and every year in order to become a market leader as that becomes a more prominent source of energy generation. Currently, the company has 47 assets in operation and under construction for renewable power in 4 different countries, and they've invested over $8 billion of capital into this segment of their business with a 20-year track record of profitably growing renewable power portfolio. So the company's done a great job of growing their existing pipeline business for natural gas and oil, but also focusing on renewables because they do see that's the future of where our economy is heading. And if we take a look, one thing I really like about Enbridge is the predictability of their future cash flows. 98% of the company's cash flows are underpinned by contractual agreements. This predictability in future cash into the company allows their management to accurately allocate capital for future growth projects as well as growing their dividend and buying back shares. So overall, Enbridge and the nature of their business provides great, predictable, consistent, and growing cash flow each and every year, and those contractual agreements also have different terms that allow for growth in prices due to inflationary measures over the long term as well. So the company has great predictable cash flow, which is exactly what you're looking for in a strong dividend payer. And if we take a look at their latest quarter's financial results, their adjusted EBITDA grew 15% year over year, which is very strong, especially from a pipeline company, and their distributable cash flow grew by 9% year over year as well to $2.5 billion in the quarter, and their DCF per share came in at $1.24, up 10% year over year as well. And why that's an important metric is because that's how the dividend is paid out. It's paid out in cash each and every quarter. And for pipeline companies which have large capital assets and massive depreciation, net income or earnings per share is not the accurate measure to use when evaluating a company's payout ratio or the safety of their dividend. You want to focus on DCF per share or the distributable cash flow per share, because that is the actual cash that could be paid out in the form of a quarterly dividend. And now if we take a look at their guidance for the full 2022 fiscal year, they're projecting EBITDA growth of 9% annually and DCF growth of 8% as well, so another very strong year coming from Enbridge. And now, of course, if we take a look at their dividend, which is the focus of this video, the current yield is absolutely massive at 6.85%. They pay out $2.67 per share per year. They have a 5-year dividend CAGR at 8.65%. And if we take a look at their dividend safety score from Simply Safe Dividends, we can see the DCF payout ratio is right around 62%, which is very safe. It's below the 70% average or preference for pipeline companies, and the DCF continues to grow annually over the longer term and is projected over the next 12 months to hit $5.45. And that gives Enbridge a dividend safety score of 70, meaning the company is considered safe at their current level with no expectation of a dividend cut coming anytime soon. So Enbridge is the first high-yielding company that may be a nice addition to an income-focused portfolio you should take a look at right now. And now we're going to continue on into stock number 2, which is ticker DLR for Digital Realty Trust. This is a REIT. They currently trade for $96 per share, and they have a market cap at just under $28 billion, with a very high current yield above 5%, and are trading with a price to funds from operations ratio of 14.3, and again sitting very close to the 52-week low at this current level. Digital Realty Trust is a data center REIT that currently operates over 300 data centers all around the world and serves over 4,000 global customers. The company has a very diverse customer list that includes some of the strongest brands in the world, including LinkedIn, Equinix, IBM, Oracle, Facebook, Verizon, AT&T, JP Morgan Chase, and among many others. Their top 20 customers are very strong, and they only make up 49.4% of their annualized recurring revenue, meaning their top 20 customers are not very top heavy. Yes, of course, a Fortune 50 software company is their largest. They use 62 locations to make up 10% of the annualized recurring revenue, but no other customer makes up a significant portion of the company's business, meaning they're highly diversified. If they were to lose one or two of these big customers to a competitor, their overall revenue stream would not be negatively impacted in a major way. And Digital Realty Trust has done a great job of continuously growing their business each and every year. If we take a look at their historical bookings, they've been growing over the long term on an annualized rate, and in the latest quarter in 2022 they just released earnings for, they set an all-time high for the company, booking over $176 million in one single quarter. And jumping over to the income statement, that is shown right here in top-line revenue growth. Each and every year, 5 years ago, it sat at $2.4 billion, and we can see year after year continues to expand to a record high of $4.5 billion in the trailing 12 months, which is exactly what we want to see from a dividend growth company. And speaking on that dividend, the current yield is above 5%. They pay $4.88 per share per year, with a 5-year dividend CAGR of 5.6% and 16 consecutive years of dividend growth. And if we take a look similar to Enbridge, adjusted funds from operations is the exact measure you want to use when evaluating the company's dividend safety. You do not want to look at earnings per share for a REIT. It's not the correct accurate measure. So if we take a look at the adjusted FFO payout ratio for this company, it is below the 90% preference from Simply Safe Dividend for REITs, coming at 76%, so a very safe and sustainable payout ratio at this current level. And the adjusted FFO per share, again, the amount of cash actually generated in order to pay out that dividend, continues to expand over the long term, and DLR currently sits with a very safe dividend score of 94. This dividend safety score is extremely high. Simply Safe Dividends very rarely gives out a very safe rating unless the company is at almost very little to no risk of cutting their dividend over the short term, and that is where I believe Digital Realty Trust is sitting at right now. So definitely an interesting company worth taking a look at, a specialized REIT that may be another great addition to an income-focused portfolio. And now we're going to continue on to the third and final high dividend paying company we're going to talk about in this episode, and that is ticker VZ for Verizon. They currently trade for just over $37 per share, and this is one of the largest communication companies in the world, and they have a market cap at $156 billion, and currently after the recent share price decline, the company is sporting an absolutely massive dividend yield of 7%, and they currently trade with a forward PE ratio of only 7.2. Verizon is a consistently slow growing business. They're not going to see any rapid expansion anytime soon, but over the long term, I do think they will continue to grow at a marginal rate, and that's why the forward PE ratio is on the lower end. Investors aren't willing to pile into this company at a high valuation, so the 7.2 forward PE ratio I think is reasonable for a company with Verizon's nature. And they are trading on the lower end of the 52-week range, and we can see the 52-week low is set at $34.55. So the company has seen a recent decline in share price, as with the overall market, which has driven the yield to right around 7% at this current level. And if we take a look at their latest quarter, the company is consistently growing. Revenue in the latest quarter was up 4% year over year, which is nothing drastic, but it does show the company continues to expand. And their wireless service revenue, which is the largest segment of their business and the most lucrative in terms of future growth potential, was up 10% year over year as well, which is a good sign. The EBITDA in the quarter just had a slight decrease of only 0.4%, so the company pretty much stayed flat on an EBITDA basis. And if we take a look at the income statement over the past 5 years, total sales continues to marginally grow from $126 billion just 5 years ago to up over $135 billion in the trailing 12 months. So nothing drastic, no rapid expansion, but over the long term, they still continue to generate more sales than the prior years. And taking a look at that dividend, of course, that is the focus of this video. They have a massive forward yield at right around 7%. They pay out $2.61 per share going forward, with a very safe and a very conservative 48% dividend payout ratio. So it's very rare to see a company with such a high yield have such a safe and conservative payout ratio, and that's why I included Verizon on this list. The 5-year dividend growth rate is nothing special, averaging 2% per year, and their current dividend growth streak is sitting at 18 consecutive years. And of course, like we did with every company, if we take a look at their safety score, it comes in with an 87. So this company is considered very safe. Like we saw with the payout ratio, they are able to generate consistent and growing cash flows over the long term. They are able to maintain their current dividend by doing slight increases annually. The company is considered to have a very safe payout ratio. And one thing I like to see is that Simply Safe Dividends actually reaffirmed this just this week on November 4th after the company released their Q3 earnings report. So Simply Safe Dividends has just updated this and maintained the 87 very safe rating. So overall, Verizon is definitely another company worth taking a look at if you're trying to grow your current dividend income and are looking for that cash flow into your portfolio each and every quarter. So those are 3 companies I think may be worth taking a look at right now if you're looking for some high current dividend income. But I know where those companies are going to outperform the market over the long term, or will they provide you any massive total returns. But if you're the type of investor that needs the income right now, is looking for that current cash flow, definitely names we're taking a look at that are paying a current dividend yield above 5%, but also have a safe dividend rating, which is very important. Remember, you don't want to chase high yields if the dividends are unsustainable or considered unsafe. So make sure you find a balance between safe dividends and high current income if that's what you're looking for. So I want to thank you all for watching the video all the way to the end. Please hit that like button and subscribe if you already haven't done so, and I will see you in the next video.